Good afternoon. I am pleased to be chairing today's Economic Policy Subcommittee hearing on the economic impacts of bank consolidation. I appreciate our witnesses joining us, and I appreciate Senator Kennedy's partnership in putting this hearing together. Senator Kennedy is on the floor right now giving a speech, but he will join us and told us to go ahead and start. So after the 2008 financial crisis and the subsequent bank bailout, Congress passed the Dodd-Frank Act, and the law was designed to ensure that giant banks could never, ever, ever again threaten our economy. But with the collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank, three of the largest bank failures in American history, two things have become obvious. First, bank failures remain a serious threat to our economy, putting taxpayers at risk for footing multi-billion-dollar bailouts if those banks go under. And second, regulators are courting disaster by continuing to encourage giant banks to grow even bigger. Treating mergers as a solution to financial instability increases instability. The problem with mega banks goes well beyond the increased risk of blowing up the financial system. As big banks get even bigger, branch closures increase, and this reduces the availability of bank services and increases the cost of credit for small businesses and for families. Now, this problem can be life or death for small businesses that can't find anyone at a big bank who understands the local economy or the actual business that is applying for credit. The problem is also worse in low-income neighborhoods where research shows that predatory lenders and check cashers proliferate as bank consolidation increases. When banks merge, consolidation has ripple effects that cost jobs, lower household incomes, and slow economic growth in local economies. Bank consolidation may boost CEO pay and investor profits, but it hurts everyone else's quality of life. The problem seems obvious, and it should be easy to fix. Congress spotted this problem long ago, and in 1960 passed the Bank Merger Act to give bank regulators, in consultation with the Department of Justice, the authority to block mergers that reduce competition, harm communities, or are not in the public interest. And yet somehow, astonishingly, between 2006 and 2021, the Federal Reserve approved more than 3,500 consecutive mergers without denying a single one, a streak that would make Cal Ripken or Lou Gehrig green with envy. Now, the net result of regulators falling asleep at the switch is that since 1990, the number of banks in the U.S. has declined from more than 18,000 down to fewer than 5,000. Meanwhile, the biggest banks, those at the very top, have gotten bigger. In the mid-1990s, the 20 biggest banks in this country held a total altogether of 15% of all bank assets. Today, the top 20 holds more than 65% of all bank assets. And the concentration at the very top is even more extreme. The biggest 4 banks alone hold more assets than the next 75 banks combined. President Biden, to his credit, recognized this problem and is working to try to fix it. In his July 2021 executive order on competition, he concluded that bank consolidation, quote, raises costs for consumers, restricts credit for small businesses, and harms low-income communities, end quote. And he ordered banking regulators to update the outdated and failed bank merger review policies. 2 years later, we are finally on the cusp of seeing what those new merger guidelines are going to look like. Last month, Jonathan Cantor, the Justice Department's top antitrust enforcer, indicated that new guidelines would be coming soon and that the department would be giving much tougher scrutiny to mergers. That is the good news. I hope that these guidelines are out soon, and you better believe I want them to be tougher than the current rules. But I am extraordinarily concerned about what we have seen in recent months from banking regulators. When First Republic Bank collapsed in April, the bank was ultimately sold to the biggest bank in America, JP Morgan Chase. That sweetheart deal cost the FDIC fund $13 billion. Meanwhile, overnight, the country's biggest bank got $200 billion bigger. And what happened to the regulators? The acting controller of the currency, Michael Hsu, rubber-stamped the deal in record time. When I asked Mr. Hsu at a hearing in May to explain how this merger was approved, he was unable to give a clear answer. But the overall picture is even worse. Instead of inattentive regulators who don't use their tools to block increasing consolidation, leaders within the Biden administration seem to be inviting more mergers. In a May 2023 statement before the House Financial Services Committee, Acting Controller Hsu reassured banks that the agency would be, quote, open-minded, close quote, while considering mergers proposals. And then earlier this week, he said, quote, simply prohibiting all mergers of large banks really locks in the concentration amongst the existing mega banks, and I don't think that's the right answer, end quote. Treasury Secretary Yellen recently warned that the banking turmoil from the collapse of Silicon Valley Bank, Signature Bank, and First Republic might lead to more mergers and that regulators would be, quote, open to them. Then the New York Times also reported that Secretary Yellen privately told big banks that she would, and I quote, welcome more mergers. These comments are stunningly wrong-headed. They indicate that key banking regulators have learned exactly the wrong lessons from the bank failures earlier this year and from the 2008 financial crash before it. Too big to fail banks pose risks to stability of the financial system, and increasing bank concentration puts a damper on small business growth all across this country. We need effective regulation and bank supervision that prevent big banks from failing in the first place. And we also need to police bank mergers to ensure that big banks have robust competition to ensure they are serving consumers and small businesses. So I appreciate our witnesses being with us to discuss how we can do that. So let me introduce our witnesses and we will get started. First, I am pleased to introduce Ms. Morgan Harper, who is Director of Policy and Advocacy at the American Economic Liberties Project. Ms. Harper has years of experience working on economic and consumer issues, including at the Consumer Financial Protection Bureau. So thank you for joining us, Ms. Harper. Next, joining us virtually, we have Dr. Michael Falkender. Dr. Falkender is the Dean's Professor of Finance at the University of Maryland and Chief Economist at the America First Policy Institute. Dr. Falkender is an expert in financial policy, having previously served as Assistant Secretary for Economic Policy at the Treasury Department. Thank you, Dr. Falkender, for being with us. And finally, we have Ms. Alexa Philo, Senior Banking Policy Analyst for Americans for Financial Reform. Ms. Philo has extensive experience in banking policy and supervision, having served as a bank examiner at the New York Fed and as Director of Risk Control at multiple banks. Thank you, Ms. Philo. Thank you to all of our witnesses for being with us. So I'm going to start with Ms. Harper for your opening statement. Ms. Harper, you're recognized for 5 minutes.
Great. Well, thank you so much, Chair Warren, Ranking Member Kennedy, and members of the subcommittee. It's a pleasure to be here, and I appreciate the opportunity to testify before you on such an important topic about our country's economic future. As was mentioned, I'm the Director of Policy and Advocacy at the American Economic Liberties Project, an organization dedicated to uprooting a primary driver of concentrated economic power, monopolies. The 2008 global financial crisis made it abundantly clear that megabanks are policy failures. Yet instead of righting those wrongs over the last decade, we've made the problem worse. In fact, it's why I left a white shoe law firm to work as an attorney at the CFPB. There, we took on the payday lending industry, debt collectors, and banks that broke the law and cheated the most vulnerable Americans, veterans, the elderly, students, and those earning the lowest incomes. At the CFPB, we used our legal authorities aggressively to hold lawbreakers accountable. In reality, however, too big to fail banks outmuscled everyone. Even as we enforced the law, they only got bigger and more powerful. These mega banks lied to regulators, cheated consumers, and neglected small businesses with no meaningful consequences. Not only are they too big to fail, they are too big to effectively regulate. Which leads us to today's hearing, as we discuss competing visions for the goals of bank merger policy. One view is the bigger the better, that big and small banks alike should swallow competitors in a battle to become one of the last banks standing. Deregulation, lax merger enforcement, and a disregard for our country's bank merger laws over the last several decades have brought us closer to this hyper-consolidated vision. In 1990, there were 15,000 banks in America. Today, there are hardly more than 4,000. The 6 largest banks control more assets than all others combined. Currently, more than 3/4 of the United States local banking markets are considered uncompetitive, and even more pronounced in rural areas. Evidence of the harms of bank consolidation is vast. Consolidation has increased the cost and reduced the availability and quality of basic financial services for consumers, disproportionately affecting low-income and minority communities. It has throttled small business formation and lending and introduced greater systemic risk to our financial system. Regional and community banks' foundational role in local economies means that bank mergers increase unemployment and reduce wages. Branch closures have devastated communities across the country, pushing more Americans into the arms of predatory financial firms like payday lenders and check cashers. As the Supreme Court put it in its landmark 1963 Philadelphia National Bank decision, concentration in banking accelerates concentration generally, as bigger banks favor lending to larger incumbent firms. And as we saw in 2008, and again this year, bank consolidation increases systemic risk, threatening new crises, which themselves are mass concentration events. Now, some of our top bank regulators, like Treasury Secretary Yellen and Acting Controller Sue, are championing more consolidation, contradicting the competition priorities of their own president. 2 days ago, the same day that Acting Controller publicly advocated more bank mergers, his own agency punished Bank of America for illegally cheating its consumers. It was ordered to pay $250 million in penalties. This is the definition of too big to fail and too big to effectively regulate. But there is a different vision for competition in banking, Congress's original vision, laid out in the bank merger statutes, aiming to protect a vibrant ecosystem of small banks that propelled the world's strongest economy. This vision prioritizes competition on the merits, where banks compete for savers and borrowers by offering better rates, easier access to credit for businesses and entrepreneurs, and more services to a broader customer base. This is the kind of competition our banking system was built around, the kind that will lead to a more stable, sustainable, and dynamic economy. More than 60 years ago, Congress rejected the consolidation-friendly views that some of our financial regulators are now advancing. Our laws did not change. Our banking regulators have. America thrives with robust and competitive banking sector, and Congress and this subcommittee have an opportunity to ensure we realize this vision. For decades, we have tried consolidation. This strategy created a worldwide economic crisis in 2008, and we cannot afford another. Congress and bank regulators must enforce our laws to restore fairness and competition in banking. Thank you again for this opportunity, and I look forward to your questions.
Thank you very much. Really appreciate it, Ms. Harper. So next, we're going to hear from Dr. Falkhinder. You're recognized for 5 minutes, and I think you're joining us virtually.
Thank you, Chairwoman Warren, Ranking Member Kennedy, and senators on the committee for the opportunity to speak to you remotely. I'm attending an academic conference in Boston, so thank you for this opportunity to speak on a safe, sound, resilient, and growth-facilitating financial system. I've been a finance professor since 2002 and had the privilege of serving as the Assistant Secretary of the Treasury for Economic Policy during the previous administration. I'm proud to have led the implementation of the Paycheck Protection Program, working closely with community, regional, and large banks, CDFIs, MDIs, credit unions, and fintechs to save millions of Americans from the potential economic ravages of the pandemic. Historically, our nation's economic strength has arisen from the ingenuity and dynamism of our private sector. Much of that growth originates from America's small businesses, who often seek credit from local and regional lenders. According to a recent Federal Reserve report, small bank loan portfolios in June of 2021 were more than 13% comprised of small business loans, compared to just 6% for the largest banks. To understand why this is the case, it's helpful to understand the difference between hard and soft information. FICO scores, debt-to-income ratios, and collateral values are hard information that can just as easily be evaluated from across the country as from across a desk. Soft information, like the unique needs of a local demography or why a particular business model is viable in a particular geography, is much more difficult to translate numerically and communicate in a large hierarchical organization. Access to financing at the local level depends on financial institutions with local roots. At the same time, technology has transformed financial services with ATMs, online and mobile banking platforms, and computerized underwriting models. These systems have large fixed development costs and low variable costs, resulting in enormous returns to scale. An implication of this paradigm is consolidation, where 4 mega banks service nearly 48% of the nation's deposits in 2022. Such consolidation creates challenges. Bankers in New York and San Francisco do not necessarily understand the local lending needs of Baton Rouge or Western Massachusetts. We must ensure a vibrant ecosystem for credit provision to America's thriving small businesses without valid concerns about systemic risk creating extraordinary burdens. This raises the third major factor, which is the evolving regulatory environment. In my view, a number of reforms are needed. First, Dodd-Frank presumes that financial regulators will stay ahead of the banks. However, if bank supervisors cannot identify and address simple interest rate risk and duration imbalances, how can we rely upon them to stave off more complicated risks? Second, the system benefits from different banks pursuing different technologies, customer segments, and underwriting models. When regulators replace the judgment of the banks with their own, regulatory failures that, for instance, overemphasize credit risk and underemphasize interest rate risk cause common shocks that put the entire system in greater jeopardy. For our largest institutions, I believe the solution is greater capital, not greater bureaucracy. Third, the systemic risk exception on deposit insurance is proven problematic. Statutory language explicitly or even implicitly saying that large banks have a more robust deposit guarantee than community and regional banks causes exactly the consolidation that policymakers should avoid. While we should perhaps guarantee non-interest-bearing transactions accounts so that American workers can be sure paychecks will clear, nowhere should law or policy provide differential deposit insurance based on bank size. Fourth, uniformly applying regulation and supervisory tactics to all banks when only the largest pose particular types of risk makes small and regional banks less competitive. Bank supervisors should not request that small banks comply with, quote, best practices, end quote, that are not mandated. Finally, bank regulation must make it easier for new banks to enter. Since 2010, only 62 new FDIC-insured banks have been chartered in the United States. Creating stricter mandates for our nation's banks may instead cause marginal activities to go towards shadow banks without making the nation's financial system safer. Regulators should work with industry and academics to identify the impediments to de novo banking so that greater bank entry might partially offset consolidation. Our banking system must continue improving access, lowering costs, and safeguarding financial information. Economies of scale mean that there will be several large institutions. Policymakers and regulators must ensure that there are enough of these banks to maintain significant competition. Regarding systemic risk, Regulators will never have the information and sophistication necessary to stay ahead of the bank's activities. Instead, much of what regulators monitor should be left to the owners of the banks. Let capital do the work of the regulators. This would greatly reduce compliance burdens on small and regional banks who cannot afford the fixed costs of the regulatory apparatus and still compete. I look forward to participating in today's hearing. Thank you.
Thank you, Mr. Falkender. I really appreciate your remarks here. And now we go to Ms. Philo. You are recognized for 5 minutes.
Good afternoon, and thank you, Chair Warren and Ranking Member Kennedy, for the opportunity to testify. I want to talk about the dangers of excessive concentration and the need for the banking agencies to swiftly update and apply their bank merger review frameworks. As you noted, President Biden issued an executive order in 2021 to promote competition in the economy. It encouraged the agencies to review their practices and adopt a plan no later than 180 days from the order, and yet here we are 2 years later, and the agencies have yet to publish new guidelines. We at AFR, Americans for Financial Reform, are deeply concerned about the concentrated power in banking and the wave of bank mergers and acquisitions that facilitated it. Bank consolidation has produced historically high concentration in the U.S. financial sector. The number of U.S. banks has plummeted from the 80s to today. And you've mentioned a number of stats here that sort of reinforce that point. The agency's history of rubber stamping bank mergers has come at a great cost, with marginalized and rural communities disproportionately affected. The Bank Merger Act and BHC Act require the agencies to consider convenience and the needs of the community. And yet bank mergers have reduced availability of credit, increased fees for basic banking services, and lowered interest rates offered to depositors. These adverse effects are even more pronounced in communities of color, low and medium income communities, where bank consolidation has led to significant branch closures. Bank mergers continue to drive large numbers of branch closures, and this disparately affects places where few branches existed in the first place, especially rural areas, especially low-income urban areas. Bank mergers' harmful effects also extend to small businesses, as we've talked about. Community banks have traditionally specialized in lending to local entrepreneurs and farmers. When banks consolidate, small business lending declines, as bigger banks tend to serve larger commercial customers. Bank mergers exacerbate systemic risk. Due to recent mergers, PNC, Truist, Capital One are now bigger than Washington Mutual, Countrywide, and Nat City when they failed in 2008 financial crisis. Large bank mergers can exacerbate existing problems, such as the too big to fail dynamic, as well as related problems such as when banks become too big to manage. The American public would be better served by the agencies evaluating emergency sales, such as those that we saw, through a lens broader than just the least cost to the insurance fund, including resulting effects on financial stability, ability to manage the combined entity, anti-competitive impacts, and other negative economic consequences not beneficial to communities served in the economy. The least cost calculation criteria should also be more transparent. In terms of needed actions, those opposed would have us believe that we need deregulation to check concentration, pointing to failures to supervise SVB. We disagree. A supervisory failure does not indict all supervision. It argues for stronger regulation and effective supervision. Also, regulations promote competition, level playing fields, and oversee systemic risk. Oh, sorry, I apologize. I want to restate. Also, regulations to promote competition, level playing fields, and oversee systemic risk do not categorically squelch innovation and diversity of business models. They can, in fact, do the opposite. Among AFR's proposals, we have listed a few here and have more in my written testimony, pausing merger approvals until guidelines are strengthened, conducting a retrospective analysis on the impact of prior banking mergers, fulfilling the obligation to determine how a proposed merger will benefit the needs of the community with a robust community benefit agreement. This assessment should consider other relevant factors in addition to the bank's CRA rating, such as guaranteeing that a consumer merger is in the public interest by requiring CFPB approval, requiring disclosure of discussions between the institutions and regulators, and so on and so forth. To conclude, the above proposals are needed to protect the American public and combat the hands-off approach to merger reviews that has resulted in increased consolidation and inflicted substantial harm on the economy, small businesses, and communities, rural and Black, Indigenous, people of color communities. Thank you for allowing me to testify today. I greatly appreciate it.
Thank you, Ms. Vilo. I really appreciate your comments. So I'm going to start with 5 minutes, first round of questions. So the vast majority of banks that disappeared over the last few decades were not financial giants. They were small banks with deep roots in their communities. These are the banks that know local communities. These are the banks that know local neighborhoods, know local businesses. These are the banks that do the painstaking local lending that is a lifeline for so many small businesses. But those local banks are the ones that are disappearing. Since the mid-1990s, the share of banking assets and lending markets controlled by community banks has been cut in half. In just the last 15 years, the number of community banks has shrunk by more than 40%. Today, 1/3 of all rural counties no longer have a local bank. The result is that more communities in America, especially rural community and communities of color, have little choice but to turn to big banks for checking accounts, loans, and other financial services. This increases costs for families and small businesses, and it has major consequences for the entire economy. So, Ms. Harper, let me ask you, what happens to a community when the last small bank in town closes up shop?
Well, thank you for the question, Senator. And I'm glad that you actually used the word lifeline, because when that last community bank, small bank leaves, it truly does take the heartbeat of the local economy with it. These small banks are, as you mentioned, serving and meeting the needs of small businesses, which fuel the rest of that local economy. And without them, we see job losses, we see less employment, we see less dynamism in that economy. And then also we see the impact on consumers. When those services go away for consumers as well, they are left with higher price services, but then also it lays the groundwork for some of those predatory firms that I mentioned in my introductory statements, payday lenders, check cashers, that once in that trap, as we know, God help you, because then that opens up the door for debt collectors and possibly even eviction. So it's extremely devastating when these small banks go away, and that's why it's so important we're having this hearing today to make sure our bank merger policy doesn't exacerbate the problem.
Really powerful point. Let me see if I can pull this just a little bit and focus again on small businesses. So let's say I own a small bakery in Sturbridge, Massachusetts, and I have an idea to open another bakery in another town, but I need a loan to be able to do that. Now, maybe I had a hard time during the pandemic. My profits may have been spotty for a period of time, but I am optimistic that a new storefront is the best long-term investment for my business. Do you think I have a better chance of getting that loan from my local community banker, if I have one, than, say, Wells Fargo that just moved into town?
Oh, absolutely. I mean, big banks are set up to serve larger clients. That's where they make the most profit, and that's where their incentives lie. And small banks have the time, have the incentive to do the type of relationship lending that is going to serve small businesses. And we also don't need to think about this in a hypothetical. The data bears out that, in fact, the largest banks are only providing about 18% of small business loans, where we see that community banks are providing about 50%.
So think about that. Wait for one more minute. So here they control all these assets, but in terms of how much of that money is making it back into communities and into small businesses, you're telling me, do the numbers one more time?
18% of the small business loans are actually, only 18% are coming from the larger financial
So
institutions.
82% are coming from the smaller financial institutions, community banks, credit unions, and others.
From
Okay.
others, yes.
Others.
But at least 50% are coming from smaller community banks. And, and the other piece of evidence that I would point to is the PPP program. In terms of the pandemic, that was an opportunity where in moments of extreme need by our small business community, which I think we're all aware of, the big banks did not step up. They were only providing 3% of those loans, and in fact, the community banks were providing about 30%.
Yeah. All right. Very interesting. So I try to think about when community banks are gobbled up by bigger banks, small businesses, which generate about 44% of all U.S. economic activity and create about 2/3 of all jobs in this country, lose their primary source of capital. And that means less economic growth and more concentration throughout the economy. So when Treasury Secretary Yellen and Acting Controller Sue effectively put up a billboard inviting more big bank mergers, they claim it will help our financial system be safer, that that's the reason they're doing this. So I want to probe that just a little bit here. Ms. Philo, we have decades of academic research on the relationship between mergers, bank concentration, and key indicators of financial stability. So does this research show that mergers are the way to increase stability in the banking sector?
Absolutely not, Senator. We saw in the run-up to the 2008 crisis in particular, but we've seen repeatedly in crisis environments that big bank mergers do increase the risk of financial crisis. You have increase in complexity with the combining of large institutions. You have increase in concentrations, increase in interconnectedness and being entwined with the financial system. So there are studies that actually document and analyze this. One in particular that's often referred to, showing that one large bank merger has negative repercussions greater than than 5 combined smaller institutions with the same deposits. What's the point?
Same deposit amount, the economic impact of the failure of one big bank is far greater than the economic impact of 5 smaller banks, even though the same number of deposits is affected. Is that right?
That is what the studies show, and these studies include, from our agency partners as well. So, I mean, this is sort of well understood and documented.
Okay. So I also understand from what you're saying that mergers increase the risk of creating more banks that are too big to fail, right? Because we keep moving up bigger here, leaving taxpayers on the hook for bailing them out when they blow up and taking the economy down with them. So that's more banks that can get away with playing the tails I win, heads you lose game that banks have played for a very long time. Ms. Harper, do you agree with Secretary Yellen and Acting Controller Sue that more mergers would make our financial system safer?
No, not at all. And it's extremely disconcerting to hear them suggest that.
And how about you, Ms. Philo?
No, exactly. A similar answer. It's concerning.
Okay. Secretary Yellen and Acting Controller Sue have it exactly backwards. Bank consolidation does not make our financial system and economy stronger. It makes them weaker. And if we're serious about protecting community banks and preventing taxpayer bailouts, then we need to fix the root of the problem, consolidation. Bank consolidation harms consumers, it deprives small businesses of capital, and it creates an ever-growing number of too-big-to-fail banks. Thank you. Senator Reid?
Thank you very much, Madam Chairman, and thank you to the witnesses. Ms. Philo, we've seen regulatory approvals of private equity-backed acquisitions of open and solvent banks, and why should banking agencies be skeptical of approving these merger acquisitions or applications, and what specific elements of private equity model are dangerous when applied to banking?
Thank you, Senator Reid, for the opportunity to speak to this. It is deeply concerning, and I'm going to refer to a letter that AFR, quote a part of a letter that AFR put out there on April 21st, 2022. The private equity industry controls an ever-increasing portion of the U.S. economy. The extractive business model requires it to acquire and consume more businesses and sectors every year. It has increased in size eightfold over the past 2 decades, from $700 billion in global assets in 2000 to $5.8 trillion in 2018. So I could continue, but I think what we've seen is private equity firms have different incentives when they come in and they acquire a bank or a healthcare organization or or an insurance company. There's a propensity to put profit first and to squeeze as much profitability out of the arrangement as possible. And as we know in the banking sector, that's not at all the intention, and I think obviously in healthcare as well.
And typically these banks are community banks, and with that kind of leadership, which is not community-oriented, you don't get the same kind of attention to the people that your customers. Is that accurate?
I think that's exactly right. Private equity firms acquiring a community bank will not have, coming in, will not have that same commitment to the local economy, will not have the same understanding of the local economy, and won't prioritize it because it won't be aligned most likely with their efforts to increase the profitability of the business.
And there's another aspect too, is that in a situation of failed banks, the FDIC will entertain offers for partial ownership by private equity. And the alternative is to sell the institution to a peer bank. It seems, again, the same dangers as private equity talked about in a full acquisition would be inherent in buying a piece of a bank. Is that accurate?
That is accurate. I think you'd have to be particularly vigilant in that context because, first, least cost could mean extremely inappropriate practices and put customers at risk in terms of the financial services and products offered. So I do believe you will get a mismatch in terms of the objective of the banking organization that's been acquired and the needs of the community.
Let me change the subject for a moment. That is, in the Dodd-Frank bill, which I participated in, we set a rule that the financial stability of the United States has to be considered in the merger calculation, the impact of the merger on the financial stability of the United States. But this factor has been unevenly appraised by agencies. Should there be more rigorous and transparent in establishing the criteria for this financial stability factor and explaining why the merger does not impact?
I do believe that we should, and I think that's a really key lesson coming off of the 2023 crisis. SVB in particular, Silicon Valley Bank made an acquisition, in the years prior to its failure, and in the Federal Reserve, in approving that, spoke to financial stability, signed off from a financial stability perspective, but said nothing, about, how that came across, what kind of data went into it. So I think that's absolutely a priority, Senator.
Well, let me ask the questions for both the witnesses here present. How does a current bank merger framework evaluate AML practices, anti-money laundering practices, and cybersecurity risk when they look at the mergers? Ms. Harper?
Well, I think you're accurately identifying that is one of the factors that should be considered in any merger review. But I also want to reemphasize, and building off of my colleagues' comments, that there is a particular role that banks in our economy are supposed to play. It is a public role, and they are chartered to fulfill that role, which is moving capital and serving the interests of small businesses and consumers. And what we know based on all of the evidence from the past several decades where we have seen pulling away of enforcing the types of rules that would require considering things like money laundering is that it is leaving our financial system less stable and creating more harms for consumers and small businesses. So that's why at this point we should have a very strong presumption against approval of mergers, and we really need to come back to the original vision of Congress to make sure that we're considering a whole set of harms in analyzing individual transactions.
Thank you. Ms. Philo, your comments of cybersecurity in particular?
Yes, I think it's a great question because there is no requirement to consider issues like that. And I think that it's an important part of the reforms that we're looking for to make sure that those tough questions are asked and that they're answered both with the appropriate data and disclosure.
Thank you very much. Thank you, Madam Chairman.
Thank you. Appreciate it, Senator Reid. So I want to take a look at another issue, and that is the rapid consolidation of our banking system isn't the result of some natural phenomenon like gravity, that it just had to happen. It is the consequence of deliberate decisions by financial regulators that have made it easier for big banks to grow bigger by gobbling up their competitors. One place where these decisions have the biggest impact is in the bank merger review process, which determines whether a bank can merge with or buy up another bank. So, Ms. Philo, you've seen this process up close, and so I thought maybe we could just walk through the basics on it. Let's go back to the bakery example here. So if I own a bakery and I want to buy another bakery, two little bakeries in two little towns, and I've got the money, I can just go buy the other bakery, right? I can cut a deal with the current owner. Owner wants to retire, I can buy the bakery. That sounds fine. But if a bank wants to buy up another bank or merge with another bank, can they just go out and close the sale the same way they would if it were a bakery buying another bakery?
Absolutely not, Senator. It's a very complex set of regulations and the guidelines. And as we know, banking organizations, not just the ultra large, are highly complex. So no, banks merging is much more complex. They need authorization from the relevant agencies, whoever is their primary regulator.
So they have to go to their regulator.
Correct.
They have to tell their regulator what they want to do, fill out an application to be able to do it. Okay, keep
a very
going.
elaborate application, I might add. There's a very intensive, as you know, focus on deposits, and yet there are a vast array of other things considered as well. And there's a period of one might expect as far, a year plus, where there's a review and an engagement with the regulators to review the merger. And,
okay.
Yeah.
So assuming we have federally chartered bank here, which most banks are, so the three regulators, the ones that you might have here, the OCC, the FDIC, or the Fed, depending on the size of the bank and how the bank is, who's the primary regulator, actually has to go through, look at all this information, and takes a year or so to go over the books, to understand the local community, and to look through before there is any approval of going forward with this bank merger. Is that right?
That's correct. That's correct. There's also a DOJ review.
So there's more. That's not
Yes,
even enough
there's
by
more.
itself. Go ahead.
Absolutely. Once that's been completed and they've worked out the application, the Department of Justice also reviews the application for its competitive effects.
Okay. All right. So a lot going on here. So DOJ, Antitrust Division, takes a look at it after the banking regulators have, and they've both got to sign off before you can go forward. Okay. So We have established banks are a little different from
different.
bakeries. Okay, got it. So banks file their application to merge, and both DOJ, Department of Justice, and financial regulators are taking a look. Now, the DOJ's antitrust division reviews all these deals and looks at them for anti-competitive effects. But a purchasing bank, the bank that's doing the buying's main federal regulator, that is their banking regulator, is ultimately responsible for approving or denying a deal. Is that right? So antitrust looks at it for its anti-competitive effects, but the banking regulator is the one who gives the final yes or no. Is that right?
That's correct.
Okay, just to make sure I've got this. So here's what I want to focus on. Since it's the banking regulators that have both the initial information and the ultimate say-so on this, what are the banking regulators looking at? You've been in this world. What is it that you would evaluate if you were a banking regulator and asked to approve the merger of two banks? Talk to me about the kind of things you would be looking at.
Absolutely. I think there's a great deal of discussion about deposits, and clearly that's a focus.
So you'd look at deposits.
Yes, but there's a great deal more. You would also, we've talked about the anti-competitive effects, but we'd quickly go to financial stability, especially for the larger banking organizations. We'd also go to public interest and the benefit to customers and communities. And then lastly, and these are in the guidelines and required, financial and managerial resources. So is the firm's, oversight and apparatus, the independent, and the lines of defense, is all that in order, and are the financial resources there?
Okay, so what you're supposed to look at is actually set out in these merger review guidelines, right? And as you say, it's things like, does it harm consumers? Can management really be counted on here to run it? Is the bank going to be stable? Is it going to destabilize the access to banking in the region? And if the regulators believe that any of those harms could be caused by the merger, what are they supposed to do?
They're supposed to factor that into the assessment.
Factor and then do what?
Into the assessment of whether to approve the acquisition.
And at least in theory, if there are problems, are they supposed to approve?
No.
That's what I want to make clear. This is what the guidelines are about. At the end of the day, they're not about saying, boy, there's a lot of problems, but go ahead. Right? Have a great time. Okay, so they're supposed to deny. So you outline this process that is designed to make sure that when a bank merges with another bank, that it doesn't endanger our financial system, it doesn't harm consumers, it doesn't harm small businesses and their access to credit. These are very important goals. So that suggests to me there should be a really high bar for approving a merger. And yet, let's take a look at the data. Somehow, the FDIC, the OCC, and the Fed, the three regulators here, have basically never seen a merger they didn't love. Since 2013, the FDIC has received more than 1,100 bank merger applications. And how many did they formally deny? Nice round number, 0. What about the OCC? Since 2013, the OCC has received nearly 500 merger applications. How many of these did the OCC deny? Answer, 0. And things don't look great at the Fed either. Since 2006 and 2021, a span of more than 15 years, the Fed has approved more than 3,500 merger applications and denied 0. In fact, out of the thousands of merger applications that have been filed over the last 20 years, just one, and that was last year, was formally denied by regulators. So let me ask the question this way. In fact, let's bring you in, Dr. Falkender. Is it your view that out of the thousands of mergers that have been approved over the last 20 years, that none of them or only one of them posed a threat to competition, a risk to financial stability, reduced options for consumers, more constrained borrowing for small businesses, or any of the other factors that regulators are required to consider?
Thank you for the question, Senator. I went to graduate school because I worked at a commercial bank and we got acquired, and that was what spurred me to go get a PhD. And I can tell you that what happened in that instance was that there was excessive consolidation in the area, and so what the regulators required was that there be spin-offs or sell-offs, divestitures of certain branches. And so it's a little bit more complicated that the mergers, that none of them are denied. Usually what happens is that if they're approved with restrictions like divestitures in order to make sure that there's still sufficient local competition.
And are we confident that that's exactly what's happened? So they've approved?
I agree with you. I've not reviewed every one of them. And let me say, Senator, I agree with much of I think my testimony revealed that I'm very concerned about the lack of local information that's lost with acquisitions. I just hope we get a chance to also, though, talk about that the biggest thing small banks suffer from is their inability to compete on technology. And so I think that where we could maybe have some conversation is how do we lower the cost of small and community banks competing with large banks on technology because of the economies of scale?
So I think that's a very important point, Dr. Falkender, and certainly something that I'm sure folks in the banking industry who are trying to run these community banks are talking about. But let's face it, as long as the big boys are out there gobbling them up, there's not much time to talk about how you spend energy and resources building up your technology. When you're getting swallowed up and the community banks are disappearing, as we see from the data here that they are, I think the consequences are pretty obvious, and I hope we can help the community banks. But part of this starts at the merger review level. So let me ask you, Ms. Philo, about your view about this. Of all these banks, for which only one in all this period of time was formally denied a merger approval, do you think that none of them posed any risk, or that there were enough other conditions put in place so that every one of the criteria were met that are laid out, the criteria that are currently laid out in the merger review guidelines?
I believe it would be hard to say that every single instance that we've had from historically going back so many decades would have met every one of them according to their specific criteria. I think that would be a stretch to imagine that.
Yeah. And I get it. People make mistakes. Regulators make mistakes. Human beings make mistakes. I understand that. But notice, if they're just random mistakes, there'll be mistakes in both directions. There will be some times when mergers will be disapproved that maybe would have been okay and not posed a risk, and there will be some times one will slip through that actually does cause harm to consumers or that cuts access to credit for small businesses. But when you see this kind of an approval rate that is effectively a 99.99% approval rate, you really have to say the system is tilted the wrong way, that we are not using a high enough bar in the current merger review guidelines. So let me just do one more quick one, and then I'll give this over to Senator Van Hollen. And that is to focus in on a merger review guideline process that has effectively become a rubber stamp. And the banks know that it's a rubber stamp. Sure, there may be a little bit of song and dance around, oh, we promised to do this in the local community, or we promised to do that, but no indication there's any particular follow-up on this. So in that context, President Biden, early in his term, called for tougher standards that apply real scrutiny to bank mergers. Ms. Harper, do you agree with President Biden that our bank merger guidelines need to be toughened up in order to keep both consumers, small businesses, and our financial system safe?
Yes, and it's very encouraging, both what we're seeing from President Biden and also from the Department of Justice Antitrust Division, that they intend to apply what is the statutory obligation, which is a holistic assessment of harms from any potential merger.
That they're actually going to follow the law.
That's a new idea, right?
There we go. So, Ms. Philo, how about you? Do you agree with President Biden on this?
Absolutely agree with President Biden.
Good. I'm extremely disappointed that when I asked our nominees to the Federal Reserve Board this same question recently, they refused to give a straight answer. I am seriously concerned that we are being presented with nominees to key roles regulating banks who cannot clearly state that they agree with President Biden that concentration in the banking industry is a serious problem. It is clear that our bank merger rules need to be tougher, and that's why I will soon reintroduce my Bank Merger Review Modernization Act, which would strengthen and modernize the bank merger review guidelines so that regulators actually do their job of protecting small banks, consumers, and our financial system from unchecked consolidation. I'll keep pushing Congress to pass this bill, but this is one time that regulators don't have to wait on Congress. I am glad that banking regulators and the DOJ are following President Biden's directive to strengthen the bank merger review guidelines, which they can do under current law. Even so, it is time to get this review finished and get it out the door. We need our regulators to deliver even before those guidelines are out, and certainly once the guidelines come out. Senator Van Hollen.
Thank you, Senator Warren, and thank you for holding this hearing. Thank you to all our witnesses. Dr. Faulkender, it's great to have a University of Maryland, TERP, as a part of the witness panel here. And I have been able to listen a little bit from my office to some of the testimony, and it reinforces the understanding that access to banking services is a really important indicator of wealth building and prospects for being able to have a successful life where you can support your family. Obviously, that includes credit scores, access to lending to purchase a home, and other things like that. In the testimony, and I think Ms. Harper, you made the point that during the pandemic, the PPP program became much more successful when we opened the doors and made it very clear that more community-based banks, CDFIs, and other entities should be conduits for the emergency funding. And you also cited the information about small business loans. I think 50% of small business loans coming from community-based banks versus the bigger banks. So clearly, access to community banking and local banking services is important for a variety of reasons, which is why I have been also troubled by the consolidation in this sector. If you look at the National Community Reinvestment Coalition reports, they found that over the course of 2017 to 2021, the U.S. saw historic levels of bank branch closures. And Baltimore, the Baltimore metro area, experienced the second highest rate of branch closures during this period of time, losing 96 branches. And yes, we have, of course, seen more of a transition to technology, but we also know that there are lots of individuals, the elderly and lower income individuals, who rely on that direct community banking relationship. So my question to you, and I think you alluded to it earlier, Ms. Harper, is in addition to denying individuals access to these sources of lending within the community, if that's not there, they often do turn to predatory lenders and others that take advantage of them. And in fact, that ends up costing them a lot more in the long run. Can you just elaborate a little bit more on that point?
Absolutely, and thank you for the question, Senator. We do see that these harms of consolidation are exacerbated in communities where we have mostly minorities and rural areas as well, and those harms are vast. As you said, I mentioned in my introductory remarks that we see increased fees, junk fees that are imposed not just even if we're just talking about the traditional system, that's more likely to occur and disproportionately affect these communities. But then also, rejection of mortgages, for example. A lot of lower income folks who might be more likely to rely on an FHA-backed loan, rates of approval will decrease based on this lack of access to banking services. And so it's very critical that we do what we can to get back to congressional intent here to recognize the harm. And I do want to get back to one of the references that the professor mentioned on economies of scale. What we don't see is evidence that we are addressing any of these harms from the economies of scale. So, great to have better technology, but if it's ending up like what we saw in the merger of BB&T and SunTrust, that you immediately are closing 800 branches, that you have customers that are so upset because they can't access good customer service that they're going to the local news to complain about it, then what are we really getting here? And are we applying the right analysis and determining whether or not these transactions are actually going to, again, get back to the statutory obligation that they are not promoting anti-competitive behavior and that they are serving the public role that the banking system is supposed to be fulfilling.
Right. No, I think those are all good points. And I think the other challenge we've got, of course, is that when it comes to the non-banking or the fintech sector, there are some good actors there, but there are also many that take advantage of the fact that they don't have the same level of standards and regulations. In fact, obviously that applies sector-wide. Some exploit that more than others. But can you just talk to the fact that one way maybe to a little better even the playing field here would be to apply some of the similar standards and rules to the non-banking fintech sector?
Yeah, I think we definitely need to have level playing field in how we're thinking about all entities that are providing financial services to consumers. But ultimately, the best way to create that competitive environment is exactly what the topic of today's hearing is, which is strong bank merger policy that is not exacerbating the consolidation, that is driving consumers to, which you rightly point out, there's some good products, but some that are more likely to hit when those banks go away, when those branch closures happen, are those that are predatory, like payday lending and check cashing, et cetera. And so it's very important that we get this right, but it's not complicated. We have the rules of the road. Congress figured it out, and we just need to make sure we have banking regulators that are going to follow that course.
Thank you, and thank you all for your testimony.
Thank you for your questions. So bank regulators' unwillingness to block bank mergers over the last few decades has made our banking system more concentrated. Bank regulators have also made the too big to fail problem even worse. During the 2008 crash, regulators arranged shotgun marriages between our nation's biggest banks, which enhanced the dominance of the behemoths that rule our financial system today. In fact, J.P. Morgan can thank the regulators for its status as our nation's biggest bank. Regulators arranged for J.P. Morgan to acquire Washington Mutual when it failed in 2008, thus catapulting J.P. Morgan to the top of the banking heap. A few months ago, America was treated to a rerun of the Get Bigger Through Marriage show. The regulators approved J.P. Morgan's purchase of First Republic so that America's biggest bank got $200 billion bigger. Now, Ms. Philo, when a troubled bank is on the verge of failing and the FDIC steps in, is the FDIC required to sell off the entire bank to another bank?
No. It is required to look at least cost, but it isn't required to sell the failed bank to another bank.
So what else could it have done?
It should evaluate the selling of the parts of the bank.
So it could liquidate the bank.
Correct.
It could sell it for parts.
Correct.
Or it could sell it in whole to another bidder.
Correct.
And when it's choosing among those options, what's it supposed to consider?
It's supposed to consider the least cost, and that's a statutory requirement. And one of the challenges is that's a very narrow requirement. That's a requirement that focuses explicitly on the dollars and cents aspect, the cost, if you will, in currency terms. And yet what we also realize is critical is the need to consider financial stability, competition, and other issues that also have costs. So this focus on the dollars and cents part of the cost is concerning.
Okay. So let me turn to you again. Dr. Falkender, according to the least cost test, if two banks put in a bid to buy the failed bank's assets, and both of those amounts are less than the deposit insurance fund would spend liquidating the bank, the FDIC would have to go with one of those banks' bids. Is that correct? That's what the least cost test means?
That's likewise my understanding, yes.
Okay. So, Ms. Philo, if a bank, let's just say Bank A, will take over the failed bank assets with a bid that we keep talking about these in bids like someone's going to make money here. That's not actually what's going to happen. With a bid that results in a $10 billion hit to the deposit insurance fund, and Bank B would take over the failed bank with a bid that would cost the fund $11 billion, the FDIC by law has to accept which bid?
The lower one.
The lower bid, the one that would cost the FDIC $10 billion rather than the one that would cost it $11 billion. Is that right?
Correct.
Okay. All right. And you were saying earlier, and that is because the only thing that really comes into this part of the analysis is the dollars and cents part of this, right? Just the dollars on what's going to happen in this purchase. Okay. So the FDIC, the question is, does the FDIC need more flexibility to evaluate options during the resolution process? And that's what I'm trying to do in the Bank Merger Modernization Review Act. But I want to see if I can dig a little bit deeper into how the FDIC arrives at its conclusions right now. I think they ought to be able to consider some other factors, but let's just focus on what the law is right now. Ms. Philo, when the FDIC is comparing the loss to the deposit insurance fund that is expected to result from different resolution options, we have Bank A bidding and Bank B bidding, how does it actually determine those numbers, that one is going to cost $10 billion and one is going to cost $11 billion?
Sure. It needs to compare, do the analysis and compare all alternatives. It needs to model the outcomes and compare all of the costs related with the transaction. This includes, a present value basis, so, traditional merger, finance, a realistic discount rate, appropriate assumptions, and I think that's really key.
Oh, I love that.
Oh, yeah.
Only the appropriate assumptions.
Yep.
Okay.
Assumptions like the assumed interest rate obviously is a big one. Assumptions around asset recovery, asset holding costs, contingent liabilities, et cetera, et cetera. The list goes on. Assumptions is important.
Okay. So throughout this, though, it sounds like, depending on what assumptions you make on each one of these, you're going to end up with somewhat different numbers, a lot of unknowns in this process, especially when we consider that banks may fail very quickly and that regulators are up all night scrambling to figure out what they're going to do. The FDIC may not have all of the information that it needs to accurately estimate the failing bank's assets, its liabilities, get them appropriately evaluated. And any tweak that you make to the assumptions could have a big impact on the ultimate outcome. So, Ms. Philo, from your experience, is there a lot of room for these estimates to vary? And or are these estimates, do they turn out to be pretty precise? What's your sense?
These estimates absolutely do vary, and they are just that. They're estimates. They're usually, oftentimes in traditional environment, they're based on, using several methods and bringing them all, bringing them to bear and coming up with as much precision as possible. And yet there is a lot of variability, and we've seen that. We've seen that in the valuation, for example, of Merrill Lynch in the heat of the 2008 crisis. To your point, the valuation takes place not only under very extremely short time frames, but in that environment, crashing markets. So it's extremely difficult to value, and we've seen the results of that being extremely difficult in terms of revisions after the fact, I think.
Yeah, I was thinking about the example, I don't know if you remember it, but on the Wachovia Bank during the 2009 crisis, the FDIC's own numbers, their own staff, said that the Wells Fargo bid would result in a cost to the fund of somewhere between $5.6 and $7.2 billion. It's a $1.6 billion. That's a lot of money in that range. So that's how challenging this is for the regulator. I want to hit one last question here, Ms. Philo. Does the public have good information on the calculations that the FDIC made when comparing resolution options for a transaction?
No, regrettably. We don't have details on the assumptions and the estimates that we would like to have, I think. And we've had to take their word for it, essentially.
Yeah. So that's the position we're in. It just kind of turns into black box at the end of the day. I don't think we ought to be taking the FDIC at its word. When making decisions about whether to sell a failed bank to a financial giant or to a slightly smaller giant, the FDIC is relying on highly malleable estimates, not on gospel. And they get a free pass by saying their models prove that that was the least cost alternative and the only way to resolve the bank under the law. The FDIC needs to provide more transparency around how it makes these decisions. If it truly was the case that a deal blew a $13 billion hole in the deposit insurance fund, which is what happened when the FDIC allowed J.P. Morgan to book a $3 billion profit on the deal when it was able to purchase First Republic, then the FDIC should have to show its math and prove that that really was the least cost alternative. Every time a financial crisis hits, all the rules that are intended to protect against greater banking consolidation seem to evaporate, even though banking consolidation is what got us into trouble in the first place. More big bank mergers is not the solution here, and we need regulators who understand that. I want to thank our witnesses for being with us today, for participating in our hearing. Questions for the record are due 1 week from today. That's Wednesday, July 19th. For our witnesses, once those questions are in, you'll have 45 days to respond to any questions. Again, thank you. And before I close, I'd like to enter into the record statements from Better Markets, the Massachusetts Bankers Association, the Credit Union National Association, and the Bank Policy Institute. We are grateful for their comments that help us better understand both what's happening right now with bank mergers and where we need to strengthen the bank merger guidelines. So with that, this hearing is adjourned.